You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood. You can check him out on Cycles News and Views on cyclesman.com. Welcome to the show, Tim.
Thanks once again for having me.
Gosh, a lot of deniers out there that keep telling us, you know, what we're seeing on the active markets right now is nothing but a minor correction. It'll be full steam ahead once we hit October. Full steam in which direction, Tim?
Yeah, well, I don't think it's going to be full steam ahead for sure. You know, here's the thing. These experts, and I don't mean for this to sound mean, but it's just a fact. Okay, if we have to go there, let's go there. Give me one expert on TV that came out in 2000 and told anyone about the top, or 2007, or give me one that told you about actually Greenspan specifically denied the housing bubble in 2005. Find me someone that did not that called the top in gold in 2011, or show me some expert somewhere that said, as I recall, the experts in fact said about crude oil in 2008 that we were at peak oil, D. Boone Pickens, peak oil. And so show me an expert that has ever warned anyone of a decline. And so if that's the case, how in the heck can you expect those same experts to tell you the truth about where we're at? We have a Dow theory primary trend change that has triggered, and I'm telling you, that's like walking through the door. And things have changed. And the danger going forward here is people not realizing the environment that we operate. And then number two is the perception and hope of false bottoms. And we're already seeing that. And it's going to be that way all the way down.
How do we know that these people aren't right?
We don't, for 100%. We don't. But let me give you this statistic. My whole thesis has been, and we've talked about this all along, and I guess it's kind of like religion, you know, or politics. You know, at some point you got to take your stance, and, you know, if you're wrong, you're wrong. But my whole thesis has been, and I look at evidence, and I let and you let the evidence stand. So let's go through some evidence. I have said all along that the rally out of the 09 low has been a bear market rally. Sounds crazy, I know. Sounds discrediting, I know. But if you look at some data and you start to really look at this, all of a sudden it makes sense. And what I mean is we've talked about the volume characteristics of the market going from 74, and I got a chart that we've done some articles. Maybe I don't know the name of it. Maybe you can reference that in a minute if you know the name of it. But showing the volume characteristics coming from 1982 all the way into the 2000 top. And what you see is as price goes, volume goes. As price would expand, volume would expand. And then, you know, price would correct and turn down and volume would turn down. But then whenever price would start back up, volume would start back up. And you can get any basic technical analysis book, Edwards and McGee, John Murphy, any basic book, and that's elementary. That is classic bull market behavior. But starting at the 2000 top, moving forward, volume began to expand as price declined into each of those lows, into the 2002 low, the 2009 low. Volume began to expand as price went down. Volume then began to contract as price went up. And people try to explain that away with, talking about saying that, it's because of ETFs, this, that, and the other. Well, at the end of the day, as they say, ultimately, whatever that transaction is, it's reflected in that underlying security. So the fact is that we're seeing classic secular bear market behavior. So then if you look at other things like, job participation rate, we've talked about that, how it peaked out and began to collapse, around that 2000 top. You look at velocity money, you look at all those things. What you see is you have an economy and a stock market that peaked in 2000. All these things the Fed has done, in spite of what people want to believe, what they have done is tried. I mean, it's real simple. I mean, just stand back, take a breath, and use some common sense and look at it for what it is. They have done these things in trying to stimulate the economy with all the, the QEs and the cutting of interest rates and all these things to try to keep that trend going that began back in 74, 82, wherever you want to call it from, to try to, rekindle it, get it going. But they haven't. And the job participation rate tells us that, the velocity money tells us that, and the volume characteristics tell us that. They haven't. All they have done is drive price to a new high, which has camouflaged the underlying issue. It's literally like having a cut on your arm and putting a Band-Aid on it and saying the cut's gone because you can't see it. It's crazy. And so I think that, like I said, based on that data, that we are operating within a secular bear market. Well, here's another thing I discovered. Within every secular bear market, going back to 1896, and I'm talking about the secular bear markets as defined by the great Dow theorist, looking at their labels, what I have found is that when I overlay the cycles work, is that every 4-year cycle has moved below the previous 4-year cycle low in every secular bear market since 1896. Now, watch this. Here's another characteristic. Here's another check. It's just this computes. If you look at the 2000 high, where I just said I thought was the secular bull market top and that we transitioned into a secular bear market based on all those things we just talked about, then the call that I made back in 2000 was for price to move below the 98 4-year cycle low, which it did in 2002. So what I just told you is that in every secular bear market, we've seen the 4-year cycle low move below the previous 4-year cycle low, and that happened in 2002. So that computes, and it fits with, like I said, that other data. Well, then we saw the liquidity campaign coming out of the 02 low that fueled us into the extended 2007 high, but look what happened. We moved below the 09 low, below the 02 low as we moved into the 09 low. So even that fits with with over 100 years of history, with secular bear market behavior. So if I'm right, what I'm saying here is that ultimately this decline takes us below the 09 low. I know that's hard to fathom, but the statistic is what the statistic is, and that is a risk. And it has held, it's a 100%. I mean, what I'm saying is that there's no failure rate with that statistic since 1896. So that is the undeniable risk to the market, believe it or not. And that's what people don't understand. 99% of the people listening to this interview do not believe that. And that's what makes this market so dangerous, is because that risk does exist. And the other danger is going to be navigating that and understanding, because if we get say a 20% decline or a 30% decline, well, everybody's going to know that that's going to be a great buying opportunity, that's going to be the bottom, especially when you see a couple of month rally coming out of that. That's going to look like a tremendous opportunity, and based on these statistics, I think it's a trap. And I think this bear, the job of the bear is to take the most money from the most people, and that's what it's about to do, I think, coming out of this top.
We'll have more with Tim Cyclesman Wood right after the break.
Unbelievable harmonies, spectacular performance, Bird Dog and the Vintage Electric Band, the ultimate tribute to the Everly Brothers and Simon & Garfunkel in Oliver, October 2nd, in Kelowna, October 3rd. Buy online and save at ontourtickets.com. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Tim Cyclesman Wood. Well, Tim, taking a look at the cycles, what's going to happen to crude oil, especially when we have new sources of oil about to come on the market? China says they've found a whole bunch through fracking, and we have Iran about to flood the market.
Well, it's interesting you say that, and looking at those fundamentals, the obvious thing is you would say should go down, but we've been saying for quite some time. I mean, we based on statistics, and it's printed in the December 2013 research letter. We called the top, the longer term cycle top in commodities had peaked once again, after the bounce out of the 09 low, which brings up another point. But anyway, I'll get back to that in a minute. But, and we've said that ultimately crude oil we thought would go into the 30s, which it has made it to the high 30s and bounced. And we've also said that any bounce along the way would be counter trend. So I guess, the short answer is that, remains, nothing's changed. I think crude oil moves lower over time, and any bounce is a counter trend bounce. And ultimately I can see crude oil even into the, mathematically and statistically speaking, based on some relationships into the 20s. But that brings up another point, commodities. If you look at the stimulus that was done to try to reignite in the economy coming out of the 2002 low, it fueled everything up. Commodities exploded into the 2008 high. Housing, we had equities, we had precious metals were on fire. Everything went up. But look at it this time, coming out of the 2009 low. The only thing they managed to push up was equities. Gold did push to a new high in 2011 and roll over. But look at the commodity complex as a whole. Yes, housing's come back some, and I realize there's pockets in places, but this time it's basically been equities. And when you look at the job participation and the velocity money thing, you know, they've gotten nothing. They've gotten nothing. It's all been in equities. And so that advance in equities, like I said, has been camouflage for what's really going on. And the danger here, I said that this was the most dangerous stock market environment since 1896, and the reason I say that is because it's the most extended, which means there's a snapback coming, which I think is probably beginning, and the fact that no one realizes it. No one gets they just don't understand what we're dealing with. And then the people that think they understand what we're dealing with, I don't think they understand what they're dealing with because they don't understand the magnitude of the decline. And like I said, the danger is going to be the perception of false bottoms and false hopes along the way.
And of course, that's what all the pushers of buying will try to tell you, is that this is the bottom. This is the perfect opportunity to step in. What you're saying is you're stepping into an elevator as the cable snaps.
That's what I'm saying. The statistics tell me. And because of those statistics, I mean, I could be wrong. But here's the thing. Are you, knowing these statistics that have been 100% accurate since 1896, are you willing to stand in front of that knowing that risk is now on the table? That's my point. And these people, look, it's, what was the saying? I don't know what I'm not going to go there. But most of these analysts and expert types they're commentators reading a script. They don't know. And if you use your head and think about it, if they knew, why didn't they tell you? Why didn't they see this coming? Why? And where's their resume? What did they tell you about any of these other things? Well, I can honestly say, and I don't mean for it to sound the wrong way, but I did. And I say that not out of arrogance, but to try to get people to understand that maybe I know what I'm talking about.
Tim, how can people find out more about the stuff that we've been talking about now for years, about how this was setting up? And you said, I'm looking for the DNA markers, but believe me, the robotics lab that looks for DNA was pretty busy at the time, and now the evidence is just piled up in huge piles, hasn't it?
Yeah, it's like I said, the navigation, there is opportunity in this, and navigating it is going to now be the challenge. And, the research is available online at cyclesman.com. And, that's it in a nutshell. It's a service. It's a very professional service that teaches. It's not just a letter. I had an email from a subscriber that told me, he said, man, you should be charging $1,000 a year for this thing. And prices are going up. They are going up. Not yet, but they are going up. So I'm just saying, the research is there if someone wants to look at it.
Tim, thanks a lot for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood. Check out his news and views on cyclesman.com. You're listening to HowStreet.com radio. Check out our very popular YouTube channel, Talk Digital Network. Find us on Twitter at Talk Digital Net. Comments about the show or questions for people like Tim can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.